Hello, everyone. It's Professor Reiko here again today, starting a new section here on the balance sheet. Our last set of videos dealt with the income statement. We talked a little bit also about the statement of stockholders' equity and comprehensive income, and now we're moving on to the balance sheet. So, just one quick thing: a lot of times in your intermediate textbooks, at the beginning of the book, when they have the financial statements, a lot of times in the balance sheet chapter, they'll also throw in kind of a brief introduction of the statement of cash flows. And that's fine. However, most textbooks have a chapter at the very end of the book uh, on the statement of cash flows. And so that's when I cover it. So I'm not going to talk about the statement of cash flows here with these videos, even though in your book, you'll probably see it and your teacher might cover it a little bit. So just make sure you understand what's expected of you for your exams. All right, so the balance sheet. All right, you'll also see this called the statement of financial position. All right, so remember this one. Remember the accounting equation: assets equals liabilities plus equity. So this is what the balance sheet's kind of showing you there. If you look there, it reports the assets, liabilities, and stockholders' equity of a business. And notice here it's at a specific date. Remember the income statement was at the end of the period, all the revenue, all the expenses that built up over the period. For the balance sheet, it's what are our assets, what are our liabilities, and what are our equities at that point in time. Right. So it's also useful in predicting the amounts, timing, uncertainty of future cash flows, which is we saw that in the income statement as well because of these right here. So liquidity. All right. So this is basically saying, does the company have the I'll squeeze a little bit of this in here, the resources necessary to pay off the current obligations, future dividends, and things like that. Solvency. The ability to pay debts as they mature. All right, and then financial flexibility is just essentially anything unexpected. Do they have the ability to respond to anything that happens that might be unexpected? All right, some limitations include historical cost. Remember, we record a lot of our, especially our fixed assets at historical cost, and that may or may not be relevant based on the fair value of that. So you'll see some investments or some assets will record at fair value, but we'll get into that as we go further into our lessons. Judgments and estimates. All right, remember, we make tons of judgments and estimates. We estimate bad debts, meaning how much do we expect? Oh, that's a B. How much we expect people not to pay us. We estimate warranty expense. We estimate depreciation, meaning the salvage life and the salvage value and the useful life and things like that. And then also there might be some omissions where we might see certain assets that aren't measurable or certain liabilities that might be off balance sheet. And we'll get into all these as they arise. All right, so the classification. So this is kind of how we put together a balance sheet. All right, so starting with our assets. Your asset section will typically be broken up into current and non-current, or it might be called long-term. All right, so assets, current assets expected to be converted into cash, sold, or consumed in either 1 year or the operating cycle, whichever is longer. And these are always going to be presented on the balance sheet in the order of liquidity, meaning how quickly they're converted into cash. So obviously cash will be first because it's your most liquid asset. With cash and cash equivalents, you must disclose any restrictions. Like if there's cash set aside for a certain purpose, then that needs to be disclosed in the financial statements. Short-term investments, these will be like our trading securities. We'll get into these later when we get into investments, but trading securities and maybe some others based on the situations that surround them. Receivables, so that think of accounts receivable, and we show these net of any uncollectible amount. So meaning if we have an allowance for doubtful accounts, which we'll get to in the receivable chapter, we will net that against the gross amount receivable. So the net number on the balance sheet will be how much we expect to actually collect of that balance. Inventories, you must disclose, the valuation method, whether it's lower cost or market or whatever, how you're valuing it, and also the cost flow, meaning FIFO or LIFO. And we'll get into all that when we get to our inventory section. Prepaid expenses, the balance represents the unexpired meaning how much is still an asset, how much do we still have to use up, so the unexpired amount. Non-current assets, assets not meeting the definition of current. So all of these will, long-term investments will have a whole chapter devoted to that. This is basically bonds and stocks that we as a company buy and invest in other companies, right? Property, plant, and equipment. This is also shown, remember, it's book value, which is equal to the historical cost less accumulated depreciation. So it's net of the contra asset accumulated depreciation. Intangible assets, these are things that lack physical substance. They're still assets, so lack physical substance. If you think about fixed assets, they have physical substance, equipment, machinery, things like that. Intangible assets do not. Common examples, a patent or a copyright or a trademark, things like that. And we'll have a whole chapter devoted to intangible assets as well. And then typically you'll see this other category that's kind of a catch-all for anything that's out of the ordinary. All right, so liabilities on the current side. All right, so this is obligations that a company reasonably expects to liquidate through the use of current assets or the creation of other current liabilities. This is, so our payables, this is our accounts payable, wages payable, all of our just pay, interest payable, there's all sorts of different payable amounts, but anything that we owe to somebody else. Unearned revenues, remember that's a liability as well because we haven't earned it yet. Unearned rent, things like that. We talked about that back in the accounting cycle videos. All right, long-term liabilities. All right, so this is obligations that a company does not expect to liquidate within the normal operating cycle. All right, bonds payable and notes payable are big ones. We'll talk about both of these later in later chapters. Deferred taxes, that's going to be in your intermediate 2. Leases and pensions, those are also going to be covered in detail. Entire chapters devoted to taxes, a chapter devoted to leases, a chapter devoted to obligations. We'll see contingencies in a chapter later on. Contingencies are like things that we don't necessarily know the outcome of, like lawsuits and things like that. So all of these are long term. So we do these financial statements and have this overview at the beginning of all of our intermediate classes. However, a lot of these items are going to be new to you, and so really it's better, it's an introduction here, but we'll learn a lot about these individual items as we get later into the course. All right, equity is the last section. So capital stock. So this is basically, it's typically common stock. Some companies might have preferred stock. It's going to be recorded at par value if there is a par value. Now, not every stock has a par value. So this additional paid-in capital is any amount above par. So if we have what we call no par common stock, and once again, we have a whole chapter on equity that we'll get to. If we have no par common stock, then there wouldn't be any additional paid-in capital because there's no par value. Retained earnings, we've talked about that already when we've done closing entries and things like that. Remember, our formula, ending retained earnings equals beginning retained earnings plus net income minus dividends. Accumulated other comprehensive income we talked about during the income statement modules videos when we talked about other comprehensive income. Remember that accumulated amount over time is an equity account, ends up on the equity section of our balance sheet. Treasury stock, we'll get into that in the equity chapter as well. It is a contra equity account. So it's basically when we go out and buy our own stock on the open market and hold it, we call it treasury stock. And then non-controlling interest, if there is any, and we mentioned that briefly as well in the income statement videos as well. All right, so 2 different ways to record it: account form and report form. All right, so the account is side by side, and then the report is just everything from top to bottom. Usually people use the report form. I have an example here of Home Depot. And then the next video, I'm actually going to do a balance sheet example. I'll probably set it up side by side just because it's easier for me to fit the solution in that way. But let's take a look over here at Home Depot and we can kind of see how it's set up and see how it lines up with what we just went over. All right, so you can see up here, assets, and that's current. and then where they have other current, and then there's our total current assets, and then this down here is all the long-term and other assets to make up our total asset section. All right. You can see, I mean, think about Home Depot. If you look here, I mean, look at this number. I mean, these numbers are in millions, so that's almost 14 billion. All right, that's the number of their inventory. But if you think about all the Home Depots worldwide, it's a lot of inventory. All right. Coming down here to the liabilities, you can see all these. So we have, once again, we have our current liabilities here, and then down here are our long-term stuff. Right, so look at all the different current liabilities. We'll cover a lot of those when we get to the current liability chapter. Like I said, we'll talk about long-term debt. We'll talk about deferred taxes and things like that. Going down here to the equity section, here's our common stock. So notice here, this has a par value of 5 cents. So they had this, this is basically what I was referring to right here. Is, I would have called that additional paid-in capital if I was doing it in class. It tells you how many shares are issued and outstanding, and that's important because the difference between issued and outstanding should match up to be the number of treasury shares here. So if you take the 1782, take these two numbers right here, the difference between those, I believe is 677. I think that works out, which would reflect the number of treasury shares. Once again, the difference between issued and outstanding is the number of treasury shares. Notice here, treasury shares, like I said, is a contra equity, so it's getting subtracted. There's our retained earnings. If we were to go over to when we did the statement of stockholders' equity at the end of the income statement mod videos, we would have seen that number for retained earnings. We would have seen this number on the statement of stockholders' equity for the accumulated other comprehensive income. In this case, it's a loss. All right, so one more key thing to look at here. Remember, our accounting equation says total assets equals liabilities plus equity. So notice that does indeed hold. The total for each of those matches up, and so we're good to go there. All right. So this is, it's always good to see an example of another company's balance sheet and financial statements in general. That's why when I'm introducing these, I like to pull up the Home Depot ones because it's a company that most people are familiar with. And they kind of, you see that the way I'm teaching it is exactly how these companies do it. Now, they may have more complex things going on, and that's fine, but it gives you a taste of what companies are actually doing. Right, so I hope you gave you a good feel for the balance sheet. The next video we're going to do will be just an example where we just take a bunch of accounts and then put them in order into a balance sheet. So I hope you tune in for that one next time. Hope you're enjoying these videos. Please subscribe to my channel, and look forward to hope you tune in next time. Thanks.